Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Bernard Vogel III. I'm just going to call him Bernie. And Bernie is a corporate lawyer and partner in the Silicon Valley Law Group. Actually, he's a partner in charge of that firm. He's worked with that firm since 2000 and has a total of about 30 years of experience as an attorney. Also comes from a family. His father was also an attorney before him. And he works in the areas of corporations, mergers, acquisitions, and finance. And Bernie and I have known each other since we were children. So anyway, I'm really pleased to have him here today. And Bernie, thanks for joining me.
Thank you, Michael.
All right. Today, Bernie and I are going to be talking about choices of forms for doing business. Today is May 20th, 2014, to give you a little reference, because this is a little bit of a moving target. And I want to caution our viewers that we're just covering some highlights of a huge area of tax law. That's why Bernie's whole practice revolves around this. And the rules relating to choosing the form of doing a business. This is a starting point to learn about some issues. We want you to get qualified tax and legal advice. This discussion is going to focus on California law. Bernie is a California attorney. I'm a California CPA. The rules do vary somewhat for other states, so just be aware of that. And with that, let's just go ahead and get started. Okay, Bernie. When starting a business, most people think about starting a corporation. Is that usually the best choice?
Not necessarily.
Okay.
As you know, the selection of the entity that you're going to do your business has a lot of tax ramifications. And in some instances, a corporation can be very adverse. A perfect example would be the holding of real estate. As you know, that would be a disaster. We still do see them from 1950s and 60s corporations having real estate. But a company that's looking for venture financing or an operating company may be more likely to be using a C corporation.
Right. Okay. So when we say a C corporation, well, maybe that's really our next question. Let's get into that. What is a C corporation? What is an S corporation? What do you think that those might be best suited for?
Well, really what we're talking about is an S election. And the difference between a C and an S is just that you elect to be an S corporation, and it's a tax election. The same operating rules for corporate law are still in a place. Sure. And the same protections for limited liabilities there for each one of them. The problem with both the C and an S corporation is when you have a liquidation.
Right.
When you have a liquidation, the assets that are in the corporation are deemed to be sold at fair market value. Again, neither of these entities probably are the best entities for appreciating real estate. They oftentimes are very difficult for even appreciating other assets unless you go in for some type of financing. An S election has very restrictive rules. Those rules include that you can only have up to 100 shareholders. You can only have persons in certain trusts. Whereas a C corporation, you don't have to worry about any of those issues.
Right. And you couldn't have a foreign investor in an S corporation.
You cannot have foreign investors in an S corporation.
Right.
Yeah.
So these days, that's probably more important than it's ever been in U.S. history, because now we're a global economy. So
not only global economy, but we have a lot of foreign residents here.
That's right.
That are doing business. They either have come here on a temporary visa, or they're working in a company here, and they're making investments just like you and I.
Yeah. So that can be an issue, and in fact, what it means is that it's an important question to come up. You know, who are the parties that are getting involved in this thing?
It's one of the first questions I ask when somebody comes in with a new entity. I said, who do you expect to get investors from?
Right. And as you said, you're limited to just 100 investors for an S corporation, although you can, in some ways, you can get around that. But the point is that if you want to have a more extended ownership, so, and particularly if you're going to get involved with venture capitalists and so forth, because they're looking to go public, then probably the S corporation isn't going to be the way to go.
Yes, and venture capitalists have their own unique requirements, and they are not very fond of S corporations. They're more attracted to the C corporation status.
Right. Now, and just to make sure that we made this clear, because I'm not sure we quite stated it, and that is, an S corporation, what happens is that the income is taxed to the shareholders. There is a small California tax that can apply, or percentage tax, but for the most part, it's going to be taxed to the shareholders, whereas for a C corporation, we have what we call a double tax system. The corporation pays a tax, and then if it makes distributions, then those distributions will be taxed to the shareholders.
That is absolutely correct.
Yeah, okay. Okay. So, are there some new developments for corporations maybe that you wanted to share with us, particularly what's going on in California?
Yes, California has followed about, I don't know the latest count, but about 6 to 7 other states, and we've put in these so-called social good corporations. As of January 1st of 2013, we're allowed to have a corporation that's called a flexible corporation, or you can also have a benefit corporation. Both these corporations are generally designed to allow a corporation to do some form of social good or give money, cause its monies to go to charity without feeling that there's going to be some ramifications from the shareholders for fear of not using the money appropriately. Both these corporations, you have to clearly state what type of corporation they are in the articles, and then you can go forth and conduct yourself not only as a for-profit business, but also make sure some of the profits can go to, say, a charity or for a social good. The Ben & Jerry's company in, I think it is in Maine, is one of the first ones that started doing this, where they let some of their profits go to supporting a social benefit.
Right. So traditionally, the corporation is supposed to be required to basically maximize profit for the shareholders. Now what we're saying is the mission of the corporation to some degree can be stated as promoting social good as well.
Absolutely. Yeah. Although there always was a reason for giving some form of profits to charities. It could be for goodwill, the name, and creating goodwill to the company. It's when you give a significant amount of money. Both of these corporations are difficult to use, and once you do elect, you have a very difficult time changing.
Right. And the deduction, there is a deduction limit for donations for corporations that's more restricted than for individuals.
That's correct.
Yeah. Maybe before we move on from corporations, so a lot of people have heard in the past, you should incorporate in Delaware. Maybe you could comment a little bit about that.
Yeah, Delaware, Nevada, or Texas is what we seem to get a lot of. New York too, every once in a while. Delaware is a very corporate-friendly, commerce-friendly state. They tax based upon the capital structure of the company, not on the profits of the company, whereas California taxes on the profits of the company. It also has some very favorable limited liability treatment, particularly for management and for the board of directors. So when companies go public, they tend to go public in Delaware. That has gotten less and less over time, but there is a favorable preference for Delaware. A lot of venture-backed companies are in Delaware, but the problem there is once you raise a lot of money from the venture capitalists, then you start getting taxed on the money you raised, not necessarily the money you made. So California's got a little bit of an edge there.
I see. Okay. Okay, what are limited liability companies, or LLCs, and why have they become popular?
Well, they've gotten very popular, as you well know, when they first came out, particularly for real estate. A limited liability company is an entity which is treated for corporate purposes. It has no liability to the owners. And much of that statutory or case law has transferred over to the limited liability companies. But from a tax perspective, most LLCs, unless elected differently, are treated as partnerships. And partnerships are a very, very favorable tax planning tool, as you well know in your practice, where you can do special allocations. So a lot of people will own real estate in LLCs. The problem with LLCs is that California wanted to be revenue neutral, and so they had to, I think, screw up a good thing. One of the things they did was they put in a $800 minimum, and then they had a gross receipts tax. Well, what that happened was sometimes you'd have an entity that has no net income for tax purposes, but it's paying taxes to the state of California. So now we do kind of a blended arrangement oftentimes, particularly for large real estate like shopping centers and things of that nature. We have it in a limited partnership, and we are able to reduce the tax there.
And maybe use an LLC as the general partner, something like that.
An LLC could be the general partner.
Right. So that way what we're doing is we're just taking a little piece of the gross receipts, and if you're under $250,000 or so, there is no gross receipts tax in California.
Yeah.
But otherwise, you have the situation where you may have a loss, and yet, and so if you were a regular corporation, you would not have to pay any tax.
Right.
But as an LLC, suddenly you do, and that can be kind of painful. In California, we have this $800 minimum tax. It applies actually to regular corporations, S corporations, LLCs, and limited partnerships.
And limited partnerships and LLPs, yes.
And LLPs, okay. So anyway, so just to be aware that when you are using these specialized entities, there is a cost that's involved, and so you just have to be aware of that going in. And so it's not something like you're playing with the business. You're trying to get this thing off the ground. You have to recognize that there's a cost that you're going to have to deal with, and it's going to be a long-term cost. It's going to hit you every year.
Every year.
And so, so one of the problems that we have with people is maintaining these things, particularly if something winds down, and whether they do it in a formal way. And then you can get into conflict with the Franchise Tax Board. So so just be aware of that. That when we're talking business, we're talking serious business, and it should be treated seriously.
Yeah, I look at the $800 as basically an insurance premium for your limited liability.
That's it.
Yeah.
Now there's other things. Now, can anybody be an LLC? Can any kind of business be an LLC?
No, almost any kind of business.
Now this is California again.
This is California, but California doesn't allow accountants, attorneys, architects, and a couple other professionals that cannot be LLPs. Cannot be LLCs. They can be LLPs, but not LLCs.
So for a while, they were actually saying that if you had any sort of a licensed type of a business, even let's say you were a contractor, that you couldn't be an LLC. And then basically there was finally a court ruling that said, no, there's a broader...
They changed the law about a year ago, about 2 years ago. It
Okay.
took them a year to implement, though.
Okay, well, good. So anyway, so you have a lot more flexibility now with LLCs than you did at one time in California. There's another thing that some people may not be aware of, and that's that LLCs can actually be taxed as corporations.
They can be if you elect to do that, yes.
Yeah.
Yes.
So,
Now, California has changed our limited liability company law this past year, and effective January 1st of 2014, our old law, which is the Beverly-Killela Company Act, that was repealed and is no longer in place. The new law, the California Revised Uniform Limited Liability Company Act, is now the governing law for not only new LLCs, but old LLCs. So there is, we're encouraging clients to revisit their operating agreements because there are some de facto or default rules that have been put into place that may or may not be what they want.
okay, maybe you could elaborate just a little bit about that, and then...
Sure.
But what it boils down to is, folks, if you have an LLC, particularly if it's a California LLC, you need to probably see your business attorney to revisit your operating agreement. Okay?
Absolutely. It's not an elected, you can't opt out. You can have members vote for all sorts of decisions by a manager unless there's a difference in your operating agreement. You can have your LLC deemed to be a member-managed LLC rather than a manager-managed LLC by default now. They did change some things that are very, very good about our distribution rules, because at one point in time, certain distributions such as compensation, there was question of whether they were distributions or true compensation. There's a lot of different rules that are in place in terms of what are fiduciary duties that are in place, which may or may not have an impact on the smaller business, but on bigger businesses such as venture funds, real estate funds, those types of entities definitely have to review that again.
Yeah, okay. So folks, an alert may be worth the whole price of admission for our watching our show today. Okay, and so let's move on to partnerships and LLPs. I guess they're limited liability partnerships, right? And what are some of their advantages and disadvantages?
Well, let's take the LLPs because it kind of breaks off of what we just talked about.
Okay.
We know that the attorneys, accountants, architects, and some other professional organizations or entities cannot be LLCs, but they can be LPs. The real difference there is that an LLP still becomes treated as a partnership, but the difference lies in liability. And so because those are types of profession that are subject to malpractice claims, they didn't want them in the limited liability companies and not be able to go after those licensed professionals. They wanted to have it in an LLP, and so that's where that lies, and that's the sole distinction, really.
Okay, so again, this is going to be, an LLP will be a choice for a professional business of some type, and I think what the idea is that you're sort of liable for your own individual work, but not necessarily for
other people in your
other people in the business.
Which is a benefit, for that.
Right.
But for partnerships, there's two types of partnerships. There's the general partnership, and there's a limited partnership. The distinction there basically lies in a general partnership. All partners are liable for the liabilities of the company. For a limited partnership, only the general partners are liable. The limited partners are only liable to the extent of their capital investment. In other words, they can lose their capital investment, so they don't have any liability personally. Both are very, very favorable in real estate, just as in an LLC, because you can do, in partnership tax treatment, we can do any type of allocation to the extent that it has substantial economic effect, right? And the benefit there is you can actually transfer all income or most income to a particular individual or most of the losses. But the rule is if you have the losses allocated, you have to have a true reduction in your capital count. These types of entities, the limited partnership and the LLC, are very attractive to what we call the family limited liability entities. The IRS doesn't like them all that much, but we love them because it's a way of transferring some type of value to future generations and avoiding estate planning, estate taxes. So, but there again, there's very, very refined rules and case law that we have to follow to be able to get this.
Right. So we might want to mention a couple of other things again. And this gets complicated. That's why, again, we say get additional advice.
Absolutely.
But if you have a general partnership, one thing that happens, let's say you've got really a negative capital account. You have losses that have been more than your investment. If you have a general partnership, you can get investment, if you will, for a share of the liabilities of the partnership, the general liabilities. Those don't pass through to a limited partner.
Right.
Whereas a limited partnership, you can pass through to limited partners what we call non-recourse liabilities. So these are very technical terms. The non-recourse liabilities, again, are very important for real estate.
absolutely.
Okay, because a typical non-recourse liability means you've got a mortgage, it's secured just by the property itself. Anyway, those liabilities can be passed through to limited partners and enable them to claim losses in excess of their basis. Then we get into other rules, like something that we call the passive activity loss rules. It's really beyond the scope of what we're talking about today. But anyway, so this is very complex stuff, but we're just introducing you to the idea of some of these different entities that are available when you're putting together a business. All right, so let's talk about the one entity that most attorneys probably really don't like to talk about very much, and that's the sole proprietorship.
Yes.
So the last resort that probably most businesses, or an awful lot of businesses, really are conducted at.
Well, and almost any business in its most infancy starts
Yeah.
out as a sole proprietorship, because you have, say, one individual thinking up an idea, starts testing that idea, and they're starting up a business. But the problem with the sole proprietorship is that you are liable for all the liabilities. So you don't get to take advantage of some of the protection of these other entities. A sole proprietorship does have its place in this world, obviously, because we have other people that are doing that. We have people doing it, but you really have to find a very, very low probability for liability for the type of business for you to do it, and that you have at least adequate insurance coverage. Otherwise, we need to encourage lawyers and accountants need to encourage those people to go to the protected entities of some type. They are attractive not only because you don't have to incur these entity costs and legal costs and accounting costs, but your accounting, your tax work is much simpler, or at least they're led to believe it's much simpler by they report it on their Schedule C, on their tax return.
Right. So instead of having a separate income tax return, as we would have really with all of these other entities, where the income and expenses and assets and liabilities are reported, the individual reports it on their Schedule C, on their individual income tax return. And again, the business is them, so for CPAs and attorneys and so forth, there is professional liability insurance that can help to insure against these things, but the other types of entities provide much more protection. And particularly if I was thinking of like a medical doctor, that you can think of malpractice cases that can get astronomical. It would seem essential that they would have to have some sort of an entity that they were using, probably an S corporation or a corporation that they would be doing business as.
And once you bring another owner on, you're no longer a sole proprietor,
Well,
you're a general partnership.
Now you have to deal with the other issues, and now there's actually the exposure. Do you have exposure even related to things that are unrelated to the business that your partner may be doing? Sometimes you can get into these questions.
Yeah.
So anyway, so we've sort of done the survey here. Each of these has certain advantages and disadvantages, and you really need to go through them. One of the things that I'll mention is probably the best one for employee benefits, believe it or not, is the C corporation.
Absolutely.
And some of this may be changing a little bit with healthcare reform and everything, but basically, you could have like a medical reimbursement plan with a C corporation that could actually, and if you got, this is a one-man corporation, now that you can pay the family's medical expenses and get a tax deduction at the corporate level, where you may not be able to get a deduction for it personally.
Yeah.
There's also disability and other things that are available. So from that standpoint, the C corporation is probably has superior things, but then you get into non-discrimination rules and other things that go from there, particularly as the organization gets bigger. So Bernie, we've just got about maybe 3 minutes left. Maybe you'd like to throw out maybe a couple minutes of wisdom related to when people are thinking through this process of getting it. Maybe particularly the thing of an awful lot of people that are just going online and saying, oh, I just want a corporation. I'll just sign up online.
That happens more than I'd like to see.
And then you've got to clean up.
And
So.
the problem is that people will do something and they'll get these kind of forms, and that's the problem. A form is for some type of business, but if there's certain decisions you have to make, or there's certain you want to raise some financing, all of a sudden all those forms become worthless, and we have to redo them. So that's very common. However, what I encourage people to do, first of all, is to make sure they have a business plan, a well thought out business plan, that they meet with say, an accountant and test that business plan in terms of what their projections are going to be. If they get there, then they have something that's been well thought out, and there's good assumptions behind it, then we can start making some good business legal decisions and choose the right entity, as opposed to zigzagging between different entities and saving costs. And believe it or not, the people that have business plans tend to be much more successful than people that don't have business plans. So.
Have an idea of where they're going. It's a lot easier to get where you're going, want to go, if you have an idea where it's going to be.
Absolutely. So, and then try to meet with the attorney as soon as possible. So oftentimes we get to see them at the very 11th hour. They could be going through an audit. They could be They could be dealing with the financing of raise some money, and they come to too late when they really need the money. They should come to us earlier.
Okay. Bernie, thanks so much for joining
Thank you very much
today, sharing this important information. Folks, maybe you're thinking of starting a business, or you know somebody who is. This video will be posted online under past episodes at financialinsiderweekly.com. We'll see you next time on Financial Insider Weekly.